Good morning, everyone. My name is Peter Holland, and I'm a Director of Property Economics at Sistri, the international subsidiary of Urbis, based in Singapore. I've got the pleasure today of moderating this webinar, and I hope you'll find this highly informative and impactful. Before we begin, look, I'd firstly like to acknowledge the traditional owners of the land I am on today, the Wurundjeri people, as well as the traditional owners of the land you are situated on, and acknowledge that Indigenous Australians have been custodians of the lands and waterways of Australia for thousands of years. I pay my respect to their elders, past, present, and emerging. Look, today we've got the second of three-part Urban Land Institute University of Melbourne series on foreign investment in Australian real estate. The first webinar we held in late March was on residential property, and this second seminar today, or webinar, is on foreign investment in commercial property. And we're going to focus primarily on the office, hospitality, industrial, retail, and industrial sectors. The third webinar, which is scheduled at this stage for May 14, will focus on emerging investment markets and how technological advancement is opening up alternative opportunities for traditional property investors. Look, I'd like to highlight that the discussions with the panel today will feed into the forthcoming ULI Asia Pac Summit in Tokyo on late May, as well as the Australian ULI National Summit on June 17. Information on these two summits will be can be accessed through the website, which will be on display at the end of this webinar. Now, let me briefly introduce the star-studded panel we have with us today, and I'm going to begin with Stuart Crowe. Stuart is currently JLL's Head of Capital Markets for Asia Pacific. He's got 20 years of experience in finance and property investment, worked across all sectors of real estate in the region, concentrating on identifying debt and equity investment for cross-border investors. Stuart's lived in Singapore since 2001. He's played an integral role in some of the largest transactions that have taken place in the region, including the sale of the Asia Square Twin Tower office project in Singapore for over $4.5 billion US in 2000, about a few years ago. Moving on to Leonie. Leonie Wilkinson oversees the portfolio management for Brookfield, Premier Real Estate Partners Australia Fund. In this role, she's responsible for fund and asset performance, return profile, pursuit of acquisition and disposal opportunities, as well as discussions with existing and prospective investors. Prior to joining Brookfield, Leonie was a member of the QIC Investment Committee and led a team of over 60 professionals covering global client relationships, capital raising, client service. Moving on to Adrian Harrington. Adrian is Head of Capital and Product Development at Charter Hall. He's got more than 25 years of experience in fund management of real estate industries. He's also non-exec Director of National Housing Finance Investment Corporation. Formerly, he was Head of Funds Management at Folkestone and CEO Funds Management for Mirvac in the US and the UK. He's held positions prior to that, James Felding, Deutsche, Paladin, and Property Council of Australia. Now, as an aside, Adrian, I can recall you 30 years ago at the Property Council of Australia, and Adrian then was a lowly property analyst, and he worked alongside another property analyst by the name of Scott Morrison, who I understand has moved out of the industry into another field, but has been quite highly influential. Ian, I don't think you were at the Property Council, but you have a long history in real estate, currently Chairman of ULI Australia and Independent Director of Keppel REIT. Ian's got more than 40 years of experience in real estate and funds management in the Asia Pac region again, previously International Director and Asia Pac Head for Strategic Partnerships at the Cell Investment Management based in Singapore. Now, as part of today's webinar, we were proposing to include a brief video presentation on foreign debt funding of Australian commercial real estate by Lei-Hua Lim, who is the Managing Director and Group Head of Financial Institutions at UOB in Singapore. They've been very active in Australia over recent years, but unfortunately, we've had some Zoom problems technically today with this video, and we won't be able to show it, and I apologise for this. However, we'll focus really mainly today on foreign equity investment in Australian commercial real estate, and this will be addressed by Leonie, Ian, Stuart, and Adrian. Before we commence, one little housekeeping matter. We will look forward to questions, so please put those in as we go, but we'll leave it till the end before we answer them, and we'll try and get 5 minutes to do that. So let's get the show started. Adrian, please set the scene for us. give us an overview of the importance of foreign equity investment in Australian commercial real estate and how this has changed over the past 2 decades, and more particularly over the past few years, including the impact of the COVID-19 pandemic. Adrian.
Excellent. Can you see that slide, Peter?
I certainly can.
Excellent.
Beautiful.
All right, thank you, everyone. And as Peter said, I'm just going to give a quick overview of the market and set the scene. This graph here is from Cushman and Wakefield and just shows the transaction volumes over the last 13 or so years. And you can see there in early 2020, when COVID hit, transaction volumes fell right away. But we've seen a significant tick up in the December quarter. And even in the first quarter, it's been a fairly active period. So the buyers are back in the market. In the quarter that just passed, we did about 4.5 billion of transactions across the different sectors, and taking the total for the 12 months to the end of March of 27.3 billion. There are a number of transactions in the pipeline at the moment, so we actually expect to see the Q2 number to be quite significant, and obviously that will be driven by the major Blackstone transaction, which was announced last week of circa 3.8 billion. So the markets are definitely coming back, and when we look at the split in the last quarter, about the foreign investors were very active, and we will continue to see, we believe, a lot of capital being deployed from offshore investors into the Australian market, and I'll go through and explain why in a moment. This next graph just shows the preferred investment destinations. INREV and NREV do a survey each year. There was 40 major institutional investors and fund-to-fund managers, and asked in the Asia-Pac region where were their preferred investment destinations. And you can see there Sydney and Melbourne, in line with Tokyo, were the key markets in the Asia-Pacific region that they were saying at the end of last year was their preferred destinations. When you go down and look at the preferred city sector destinations, not surprisingly, Sydney and Melbourne in industrial logistics is number 1 and 2, closely followed by Tokyo residential. Sydney office and Melbourne office also make that top 10. So that's where, again, our view is where most of the capital will be flowing from foreign investors into Australia in the next 12 to 24 months. Will be primarily focused on that industrial and office sectors. This graph here just shows the spreads across the different sectors. What's quite interesting is just where they sit relative to the standard deviation over the last sort of 21 years. And our view is that, office cap rate spread does remain elevated, and it's looking pretty attractive, notwithstanding the issues, and we'll no doubt talk in the panel in a moment about the move back to office and the work from home and the revolution that's taking. What does that mean for demand? But our view is that at the moment, when you look at that spread relative to 10-year bonds and the historical, office is still coming up as a reasonably good buy, particularly in neighbourhood retail. That's been very strong, and we still see further cap rate compression in that part of the market, which is obviously very different to what's happening in the mall segment. And industrial cap rates, well, when you look at this slide that just shows Australian industrial cap rates relative to the rest of the world, we are going to see a significant re-rating of industrial at June. The milestone Blackstone deal that went through at circa 3.8 billion is rumoured to being done on a yield of around 4%. And that's a major portfolio with some 45 assets. So if the average yield is 4%, there would have been a number of the properties in that portfolio that would have been valued on a sub 4% yield. We've just seen a Best and Less distribution centre out at Eastern Creek, bought by Lendlease through their APPF industrial fund on a reported yield of 3.6%. So we are expecting, when we revalue our $11 billion industrial portfolio at June, to see quite a significant compression in industrial cap rates and bringing them much more in line with global yields. This one here, just something a bit different. A lot of talk about the office markets, and we'll no doubt in the discussion drill in a little bit more. But this just shows the average return and volatility of the key Australian markets over the last 10, 15 and 20 years. And Australia's on a Sharpe ratio, which is a risk-adjusted return, comes up as being a very, very attractive place to invest. And we would concur that going forward, that Australia will continue to be a very attractive option for global capital looking for a home in the office sectors in the Asia-Pac region. And then finally, Peter, just in terms of, looking at what industries, there's been we saw that in the GFC, and we've seen it last year with COVID. Tenant covenant is critical, but also being what are the sectors that are going to grow when it comes to tenant demand over the next 5 to 10 years. The Australian government, these are the industry growth centres that they're focusing in on with all of their different industry plans. And not surprisingly, a lot of it is tech related there with cybersecurity, medical and technology, and then obviously resources, and a growing one is food and agribusiness. And just to put that into perspective, in our industrial portfolio of about $11 billion, just under 50% of the tenants are in the food and food distribution, food manufacturing sector and consumer staples. And we see that as being a massive growth opportunity with not just through Woolworths and Coles, but also through groups like the online delivery, Marley Spoons and other groups. So I think that just sort of sets the scene that we've got a government that's very much committed to growing our economy, very focused on those industries that are going to be growth industries that can support an economy such as ours. And I think there's a lot more focus on a number of these industries in a post-COVID world. I'll hand back to you, Peter.
Thank you, Adrian. Stuart, picking up on that point on cap rate compression and Australia sort of coming more in line globally, you see it from doing deals around the region. What is the attraction of Australia, and how is it comparing going forward, do you think, relative to other countries? Obviously, it looks as though we've made some major advancements in that area.
Yeah, thanks, Peter. And thanks, Adrian, and for the overview. I think Australia is obviously very attractive. Not least of which, I think the starting point is there's just lots of money around. Generally, there's a lot of liquidity in the real estate markets. There's a word that people keep using about dry powder, and people keep talking about hundreds of billions of dollars. I think in the Asia Pacific region alone, we've calculated that within various funds, there's probably $100 billion of money looking to be deployed in Asia Pacific, of which Australia is a part of Asia Pacific. And as Adrian talked about, volumes are very strong, and we're at JLL forecasting that volumes in the Asia Pacific region will be up 25% this year. And barring 2020, which was the first time that there was a downturn, there has been year-on-year increases in Asia Pacific for 10 or 12 years in a row. So Asia is becoming more popular. There's a lot of liquidity in the markets, and the structural trends around real estate accelerate that there's a lot of money to be deployed. And Asia is very, very popular. And as Ian and others know well, some of the biggest investors in the world are not from Asia. Increasingly, there's many big sources from Asia, but particularly from the US and Europe. And they see Asia as a diversified part of their portfolio, and they're seeing the benefits of diversification. And as I say, Australia is a net beneficiary of that. The other trend that we're seeing, and really has continued and accelerated post-GFC, is that people are looking for yield. I suppose there is this continued attraction to safety, to stability and for yield. And that's really because some of the biggest investors in the world are looking to fund liabilities, whether they be from pension, insurance schemes in their home countries. And Australia has provided that. Australia and Japan are probably the two markets in Asia Pacific that there is yield and there is safety and security. And again, really since GFC, and that has accelerated over the last few years, Australia has been a net beneficiary from some of the largest global investors in the world looking at yield. So that's a trend that has helped Australia. And at the end of the day, when you look at Asia as a destination, there's only a few markets where you can really say with some definition that there is safety and security and transparency. And Australia, again, is a beneficiary. Investors are attracted to the transparency, they're attracted to the rule of law, they're attracted to the depth of the capital markets. And even in the last 12 or 18 months, again, this has accelerated. They're attracted to the recovery from COVID, and they're attracted to the strength of the underlying economy. So all of those things are great for Australia. And again, it's a net beneficiary from the structural trends that occur around the world. And as Adrian said, investors are attracted to the yields. On a relative basis, the yields in Australia have been higher than other markets in Asia. And just a couple of other points. I think there's global investors are also looking to sort of get ahead of the curve, and some of the secular trends that have been evident in other markets around student housing. There's a lot of discussion around build to rent or multifamily now. Big global investors have seen those investment theses as being very successful in their home markets of the US and Europe particularly, and they see Australia as a mature Western economy that will ultimately, some of the same secular trends around build to rent, around e-commerce, etc., will play out in Australia. And again, they're attracted to that. So all of those things are great, and that has meant that Australia has been again the net beneficiary of lots of offshore capital, and it's changed massively in the last 10 years. We see that continuing. I think probably the only issue, Peter, for the panel and the participants to consider is that Australia is actually very reliant on offshore capital. And you saw that last year where there was very little trades done, despite the fact that there is a big superannuation repository of money in Australia. Some of the trades are still very reliant on offshore capital. So that's one thing for the market to consider. But it's a very attractive destination.
Okay, picking up on that, Ian, I mean, clearly Australia's done pretty well in the Asia-Pac region and has punched above its weight. I mean, do you see Asia, when you're looking at it from a foreign investor's perspective, as Australia as part of Asia, or do you keep it as really quite separate? And the funds, as I understand it, quite often bundle it up as Asia-Pac, and hence they're attracted to Australia because it's easier for them to actually invest in.
Well, that depends on where you're coming from. If you're sort of residing in North Asia, in China or Japan or something, they may not consider that part of Asia, but the rest of the world definitely sees Australia as part of Asia Pacific. And Australia does punch above its weight from a GDP perspective. If institutional investors were allocating capital for their global real estate portfolio to Australia, we'd get about 2%, but we get significantly more than that for exactly the reasons that Stuart was just referring to. I won't go over those, but I might add one more, and that is transparency of the legal system. And without being too pointed, for example, an institutional investor has to consider very carefully risks and always looks at the worst case scenario. And if an institutional investor was to buy a core asset in China or India versus Australia or Japan and ended up in a worst case scenario in a massive court battle with a domestic partner, perhaps a state-owned organisation in China, to finish up in the court system in some of those countries is not an option, whereas the court system in Australia is very well known, understood, very transparent and fast. Same in Japan, same in Singapore, and so that is why those markets attract significantly more foreign capital than others, plus the reasons as Stuart's outlined. Australia does have some added difficulties, and if Lim Lei Wah we'd been able to show her video, we might have heard a bit about that. And I refer particularly to the volatility of our currency. So all foreign investors in Australia, of course, must have give consideration to hedging their currency risk. And the Australian dollar is, relative to other major currencies, really expensive to hedge. And that's because it's relatively volatile compared to other currencies. So you'd find foreign investors use significantly more debt in buying Australian commercial real estate than they would either in their home country or in some other foreign countries with more stable currencies. To get, and all that debt, of course, is in Australian dollars, even from international banks, it's in Australian dollars, which reduces the equity component of their investment and therefore acts as a more natural hedge. Then they have to pay for hedging of their equity and hedging of their distributions from Australian dollars back into their home currency. So despite all that, or that impost, Australia remains increasingly attractive to foreign capital for the reasons Stuart outlined and Adrian outlined, plus the additional point I just made.
Thank you. So maybe on Leonie, you know, we seem to have come through COVID-19 or the commercial market a lot better than expected, right? And part of that obviously has been compression of cap rate, which has offset loss in rental income. Is that the main reason that this is, or how do you see it?
I might start just by picking up on some of the comments Ian and Stuart were making, because I think another way that we've benefited ourselves and our clients coming through COVID was the way we conducted ourselves as everything went into lockdown, and the structure and cohesion of the industry working with our tenants through that very prescriptive code of conduct really put us into another level of desire, I think, from foreign investors' perspective, because we received, well, I personally received compliments from investors that have exposures all over the world that observed the way we conducted ourselves as an industry and worked closely with our tenants, and were able to work through these code of conduct and rent relief arrangements in a really productive way, which ultimately for our clients meant that they didn't get surprises. And it just touches back on Stuart's point around transparency and Ian's point around the rule of law. I think we were really tested and came through with the backing of all this terrific infrastructure we have in place. And I think also the culture of our industry, we're generally very collaborative and happy to work together and famously transparent. So I think that that's enhanced our reputation even further. And completely agree, mathematically, we continue to pencil out as a very attractive forward return investment destination. I think it'll be interesting when the industrial sector re-rates off the milestone portfolio. That's going to be really, really attractive and will probably mean that the forward returns, because it's such an exceptionally competitive space, will be a little less just because there's so much competition coming in, but then very strong fundamentals supporting that into the future. So I think in terms of then from a financial performance perspective, the last 12 months or so, I think taking a step back, the industry as a whole had very good management of our rent collections, and we're able to work through that productively. Cap rates, I think in the main haven't, so absent the industrial sector, which we'll all see that cap rate compression come through. We haven't seen a lot of cap rate compression actually so far, at least in the office sector. In the retail sector, it's just very, very hard to generalize. Retail's so so unique in so many different subsectors of retail, but some of those have started to trade at compressed cap rates because of changes in the way that we're all interacting with retail. But until we see more transactions come through, we haven't seen a lot of cap rate compression come through our buildings. So in the main, we've had a good, stable a good stable year, but I think some disconnect between sentiment around sectors like office, where people just aren't quite sure what the future looks like. And the trades have been coming through because investors have been able to look through current volatility, perhaps in income and into the next cycle, but there's potentially some good buying in there as well. So I think it's still got a little bit to play out in terms of cap rates. To Stuart's point, with the interest rates where they are is something that we often talk about. The spread's very important, but also I think the requirement for income, regardless of where interest rates are going in the future, a lot of the developed countries do have pension funds that are moving out of that accumulation phase into a retirement incomes phase, and will be very focused on income. So I think that will continue to support demand for real estate.
Excellent. Adrian, we've had a few recessions and cycles in our market. This one's obviously different. The last being the GFC and so on, the impact of that on the property market. Can you see a point where we're actually going to have distressed property? I mean, we haven't as yet, or it's been evident, but is that likely to happen?
Not really. This has been a pandemic-led downturn, whereas back in the GFC, it was a capital markets particularly led downturn. So the distress, because of the recovery that we've had, and I finally think back to March last year when everyone was arguing whether it was going to be a V-shape, U-shape, elongated shape recovery. The fact that our economic growth has been so strong in the last quarter, the unemployment rate fallen back to 5.6%, puts us in a position where there is a little bit of distress out there at an individual level, where people may have overpaid or their financial system has changed. And we've seen that with reports in some of the hotel owners have had to put hotel assets on the market. But by and large, unless you're a mall owner, and we've seen those hit pretty hard, the rest of the market's held up remarkably well from where we all thought we would be 12 months ago.
So, Ian, moving on from that and continuing the same point, obviously industrials become the darling for the time being. Retail and hospitality, however, have been hit as industries, and as a consequence, there has been some issues in relation to the property. How do you see them panning out, both retail and hospitality in particular?
Well, hospitality is organisation. Adrian, you asked Adrian about distressed assets, and I think the only place there could be some distress, and is some distress, is in the hospitality sector. And there's a number of reasons. Most of the groups that own those assets are extremely well capitalised. However, as I mentioned, from a foreign capital point of view, they would have more debt on Australian assets than they would on other assets. And of course, that would place them under increased pressure. Everybody's waiting for some level of recovery in the tourism industry and more domestic travel. It's very slowly starting. I think foreign capital in particular will stand back from the hotel market for the time being, expecting more distress, but foreign capital will absolutely be interested to step back into the hospitality market once a clear trend of return to travel is established. Retail, not necessarily the favoured flavour for the bulk of foreign capital, because like hospitality, it is a more specialised real estate asset class. I note from Adrian's slides that neighbourhood retail is performing strongly. I completely agree with that. That's harder for offshore capital, institutional capital to access, because there are many more Australian-based investors that can participate at that end of the spectrum, and because the deal sizes tend to be smaller, and the fact that the deal sizes tend to be smaller is less appealing to offshore capital, who need to put their capital out in much larger chunks to make it worthwhile.
Peter, can I just add to one thing
Sure.
that Ian said in relation to the high debt levels that the foreigners are carrying? I must say that the Australian banks have performed exceptionally well this time compared to the GFC. The way that the banks behaved back in the GFC, the Australian Big Four banks, was quite frankly disgraceful in terms of forcing capital raisings at significant dilution to investors in the listed REIT sector. We own 2 hotels, one down at Sydney Airport, the Novotel, and as you can imagine, we got down to 15% occupancy, and the only reason we had 15% occupancy was because we had a couple of airlines staying at the hotel. The way, I won't say which bank it was, but the way the major, one of the Big Four banks here, who was the banker to that deal, has sat down with us and worked through adjusting covenants and things like that, has been exceptional. Whereas if that had been back in the GFC, they would have just come in and said, right, you're in default, bang, we will put the property on the market, and that fueled almost a cascade of changes in the market. So I think one of the other reasons we haven't seen distress in this market is the banks have behaved very well.
Okay, look, we're going to move on to the office sector, and look, this is the really interesting one. It is a wait and see. I think, Leonie, you mentioned this before. You're a massive investor in that sector. You're obviously pretty confident by the sounds of things, and the whole issue of working from home and these other trends that are around, how do you see it playing out? Do you have a view, or it is wait and see?
I know we have a view. So we thought it was important to take a view. So our view is there'll be a bifurcation. So with the changing dynamics around how people use the office, firstly, we believe the office will continue to be a very important part of corporate strategy, and bringing people together is very important to help work collaboratively and work productively. So we're comfortable with that. I think the next question then is how much office space is required and how are people going to use it. And our view there is that people are going to be even more demanding than they have been in the past about making sure that the office space is somewhere that people want to come to work. So really, it comes down to an evolution of investment in placemaking and sustainability. And placemaking really is just making sure that the office space that you have is part of an overall high quality experience that your employees can have when they come into the office. And we want their time in the office to be part of their life and have everything available at their fingertips that they would like to do during the course of that day, rather than somewhere where they go to do a job. And so bifurcation, what we mean is that those really strong offers around a very attractive office that helps people do the kind of things that they want to do, both inside and outside of their working day, are going to continue to be very strong. And if there's an office space that is lower grade, undifferentiated, not very exciting, doesn't tick any of the traditional boxes around good location, access to public transport, and all of those things that we've all been looking for a long time, they'll probably quite quickly become obsolete. So it will just start to continue to separate. Coming into this downturn, office is a very cyclical asset class. So we saw coming into this downturn a real convergence between pricing on primary and secondary grade office, as we do every peak of every cycle. And so as we've come into the downturn, we've seen that starting to separate. We haven't seen it separate as far as we expect so far in Australia. And I think partly that's because of the weight of capital. Just back to our earlier point, there's so much capital seeking exposure into Australia that there has been, really surprising to us, people buying in even to that lower than prime or premium grade office at book or higher val. However, we think to stay relevant and attractive to both occupiers and capital, it's going to be, even more important than it has in the past to be in that high quality space. So that's our view, Peter.
Thank you, kindly. So, Ian, I know you've talked about suburban locations and having renewed interest. How do you see again that panning out? Is there going to be more interest by foreign investors to actually not be so focused on CBD, but to go to secondary locations in suburbs and district centres?
Short answer is yes. But of course, it's not that easy. That they're new markets for most foreign investors to get to understand and get their head around. I can speak for the Keppel REIT. about the middle of last year, June, July. From an investment strategy perspective, we absolutely pivoted to expand our horizons out of the CBD and into office parks, specifically driven by the pandemic and some of the things that Leonie was just mentioning in terms of workspace. And we have already bought one office park in Sydney, the Pinnacle Office Park out in Macquarie Park area. We're just about to close on a major office park in Singapore, and we're out looking for additional office parks. And that is to, our portfolio to date has been prime major CBD blue chip office towers only. So we are specifically, as a result of the pandemic and the anticipated changes in workplaces, adding prime suburban office parks to that portfolio.
Stuart, can you add to that from your perspective, looking from the investors coming in?
Yeah, I think it's different impact on different markets. It's still a work in progress. I think the office sector. I think what we're saying to our investor clients globally is that there is definitely a change, and we use the well-term phrase that COVID has accelerated trends that were already happening. I think that's also the case in the office market. So everyone is taking flexible working into their consideration when they're both from an occupier perspective and an investor. So I think every office building will have a component of flexible office space, whether it's a WeWork or a co-working operator, or indeed the owner itself will provide flexible. So the workforce is definitely becoming more flexible. That will have an impact on office demand, but only minor, I think. And I think what Ian has said is that some investors are looking at more of a hub and spoke model. The purchase of suburban office campuses or parks is fueled a little bit by that, but it's also fueled by the fact that in many cases the leases on those assets are longer, the yields are slightly higher, and again, going back to one of my earlier statements about just the safety and security of yield, which is very prominent in investors' minds at the moment. Hence, they're very, very attractive. So, yeah, I think in simple terms, there is definitely an impact on office demand, but we don't see it as a major impact. And I think that some markets will perform better than others, and commute times and the nature of how people live and work in different markets will play a part in that.
Excellent. Adrian, investing in social infrastructure property, including health and education, has recently become more popular with Australian institutions and funds such as yours. Do you expect this to attract increasing amount of foreign investment in those particular sectors? And if you just expand on that a bit.
I definitely do. I think that we've been a bit late to the party in terms of the adoption of alternate assets as part of an Australian pension super fund or insurance company portfolio, but we are definitely seeing that shift. They are looking more at these sectors now, whether it be health or data centres, student accommodation. Ian mentioned earlier the build to rent sector. So I think from that perspective, absolutely. The critical issue here is just the ability to get scale. And how do you get scale in these sectors? And how do you underwrite the covenants? Because it's all good and well to run around and say, I'm buying a bunch of medical centres, but a lot of the covenants are doctors and things like that. The big good covenants, the Healthscopes, the Ramsays, they're very hard to get in that health space. So the big issue is scalability in this market, but definitely everyone is talking about it and everyone is looking at these sectors. And I think there will be both domestic and foreign capital chasing assets going forward.
Good. So Leonie, ESG considerations are becoming increasingly important to many investors of commercial property. Is this going to be an issue for foreign investors when they're looking to come into the Australian market?
I think we're all aligned. I think that we've all moved to a point where people recognise that sustainable investment is complementary with profitable investment. So I think if I rewind to maybe a decade ago or a little less, when we started speaking with groups who were very demanding around sustainability criteria and meeting certain goals, I really distinctly remember that it caused, consternation is too strong a word, but it just caused a pause and really help us understand what this means for our financial return. And I remember very carefully drafting in wording to say, we'll do this as long as it's not going to be detrimental to our financial return. I think now that's completely gone away. People are fully embracing sustainability. It's something that occupiers are demanding as part of their accommodation in any type of asset class. It's sorry, Stuart, to use the word acceleration. I know we all hear it a lot, but acceleration around things like demands for indoor air quality are just so much stronger now than they were pre-COVID. So I think it's very well accepted, and I think it's complementary to having a future fit asset across any of our sectors. So it's a wonderful confluence actually of all of these different sectoral trends that we're seeing, and it's lovely to have our industry play a role in helping that. And we're actually starting to see it a little bit more than just risk management now. We're actually starting to see it as a real commercial opportunity for us.
Yeah, and I think it's fascinating because Australia's really been a leader in that field, and we've done a reasonably good job.
Yeah.
And moving on to a sort of a less traditional sector in the market, which is agricultural property. This appears to be attracting foreign investor interests as well, and it could emerge, as we discussed the other day, as quite a contentious issue down the track. Are we in danger of selling the Australian farm?
We are, and that's not good. And to counter that, what I would like to see is to get its head around investing directly into agriculture, as many foreign pension funds have been doing for many, many years and are already doing in Australia. There is, there are obviously, you're not going to buy a huge agricultural, or get a lot of agricultural capital invested in agriculture with a big long-term lease to an institution. That's not going to work. So it'd be more like hotels where you're taking operating risk. There are some outstanding agricultural management companies in Australia. They're getting a lot of capital from offshore. There should be a significant allocation of Australian capital to agriculture, in my opinion. If you look at a global investing institution, and many of our big superannuation funds now are globally investing, the big US, Canadian, European, Middle East sovereign funds, others allocate somewhere between 10 and 20% to alternatives. Alternatives includes real estate, agriculture, and timber. And the bulk of that goes to real estate, but a significant amount goes to agriculture and a significant amount goes to timber. And I think most people on this webinar are Australians. A lot of us manage offshore capital, but in my view, having a large and increasing amount of foreign capital being directed to Australian agricultural assets is cause for concern. And as an Australian, I would like to see far more Australian capital, institutional capital, directed to agriculture, Australian agriculture.
Watch that space. Look, thank you for those who've dialed in with questions. We're going to treat those in a moment, but we've just got a few final questions, which are rapid fire, and these are to be answered by all panelists as they see fit, and very rapidly, please. No diatribe. Just give us the result of your opinion. Cap rates over the next 3 years. Do you expect them to bottom out or peak or whatever for the major sectors? And Leonie, you lead off with office, prime, CBD and suburban prime. How do you see cap rates going? Anyone who differs, just jump in over Leonie when she's finished.
I see both going down.
Down. Okay. Anyone differ on that? Come on, have a contrary view, Stuart.
Well, office in Australia is not that easy because there is the face yields, and then I see yields going down, but incentives going up. How about that?
Well, I want the real yield, pal. I don't want this fancy incentive stuff just distorting everything.
Yields will go down a bit. Yep.
Okay. Adrian, regional moles. What's going to happen, pal?
They're blown out, and I think they'll probably stabilise, but I don't see them firming too much for at least the next 12 to 24 months. But the sub-regional will struggle, and the neighbourhood or Bunnings are going to continue to be re-rated. We're seeing trades on Bunnings now sub 4% on one deal, but they'll be in the 4s. And I think in terms of neighbourhood shopping centres, they're going to continue to re-rate in this lower for longer low interest rate environment.
Okay. Stuart, industry, I know you've got a little deal on your hands at the moment.
Well, I've been telling people for the last 5 months that yields are going to go down, so I will stick with that they will continue to go down. So I think the milestone transaction, which JLL proudly was involved in, was a starting point for that.
Excellent. No different views on that from anyone? No. Still further to go. Ian, what about the hotels, CBD hotels to start with, and then resort location hotels?
Historically, I've always argued cap rates are, compared to office and industrial retail, not the right way to look at hotels, because in hotels you don't have a lease. There's no lease income. The owner gets a share of, with the operator, a share of the gross operating revenue and a share of the net operating profit after the operator's costs. So you need to look back over time to analyse what that income stream has been, and then you need to look forward over time to project what that income stream has been, and then apply a cap rate to that. Right now, that doesn't make any sense at all. If you want a simple answer, cap rates are blown out to blazes, and they will come down.
Thank you. That was a simple answer. It was a long one, but a short one. Looking ahead to the new normal in, say, 3 years' time, when hopefully COVID-19 is out of our minds and life is back to normal. If you look at Sydney, Melbourne CBD office workers, what would you expect the typical number of days spent per week working from home as compared with the CBD office? Adrian, away you go.
4.
4 days in the office, 1 day out?
Yeah.
Okay. Leonie?
I just can't answer it as a generalization. I can't do it. I know you're challenging one or the other. It's too nuanced.
Okay. Stuart?
By role and by company. Yeah, I think it's too hard a question, Peter.
Okay, that's all right. Stuart, any views?
Yeah, I think everyone will start to work more flexibly. So I think 4 is a good number.
Ian?
I'll probably go with 4 as well, but I'd like to put some nuance in, like Leonie was saying. I think young people should be 5 days a week without any question. Young people
100%. A young, ambitious person is not going to sit at home. Yeah.
Correct. And I would like to see working mothers being allocated more time to work from home than anyone else. There's no real reason for anyone else to work from home other than the fact that we've got a bit used to it. And I stress again, young people need to be in the office.
And I'd argue that that 1 day at home can't be a Friday either.
Yeah.
Or Monday.
Or Monday.
Yeah. Okay.
And companies are going to start to do that. We're talking to our tenants, and there is a peak on Wednesdays, and there's a big drop off on Mondays and Fridays. And some businesses are now some of our tenants are telling us that they're going to mandate that what day you can come in. And not come in and to avoid this peak because they're struggling to fit everyone in on a Wednesday.
Okay. Just comparing back to 2019 and looking at the level of foreign investment in commercial real estate, do you think going forward over the next few years it's going to be around that level, lower or higher? And if it's higher, who's going to be the main beneficiaries from this? Start with you, Leonie.
I think it will increase, and I think if we can unpick some more industrial exposure, that's where the volumes will come in.
Good. Stuart?
Yeah, I think Australia continues to be attractive. There's a lot more money, so there will be continued investment in Australia, and the Aussie fund managers, as Charter Hall and others, will be beneficiaries of that, because the partnership model with local expertise on the ground is also a structural trend that continues to change. Yeah.
So that's good news for you, Adrian, by the sounds of it.
Absolutely.
I'll move on from you. I'm not going to talk to you. Ian?
I believe the volumes will increase and continue to increase. As to who will be the beneficiary, I think basically the office sector, the industrial sector would be, if there was any stock left. You know, with the big portfolio that Stuart's sold, going to offshore capital, Ishang Redwood and GIC and what have you, which will be debt funded substantially by offshore debt led by United Overseas Bank, who we didn't see. What's left now is a series of big sheds from time to time here and there. But even a big shed's still only $50 to $100 million. That's too small for your average offshore institution. So it'll be the office sector, where sizes are getting bigger and bigger and bigger.
Final question. What advice would you be giving to the Australian government in relation to making policy changes relevant to foreign investment in Australian commercial property? Any advice you'd like to give, Stuart, from a distance to start with?
No, not really. I think the Foreign Investment Review Board is a necessary process. I think there's still some lack of clarity around the timing of that. And we've gone through that on many processes. For different investors, it takes longer, rightly or wrongly. So there's perhaps the speediness of that process needs to increase. And I think, the build to rent sector is a sector just willing itself to keep going in Australia, but clearly there is some tax and some issues in Australia around its classification around MIT. So I think some certainty and clarity around that will be beneficial as well.
Ian?
I agree with Stuart. I think the FIRB process is fine. I want to touch on build to rent and the MIT status. If our industry and the government gets together and makes sure that build to rent starts and stays as an institutional asset class and stops thinking about it as speculating in apartments and what have you, and designates MIT status to offshore investors and a similar tax outcome for Australian institutional investors in build to rent, that will be a major game changer, not for the international investment market, but for the Australian, for the average Australian person to have a better place to live.
LEONIE?
I completely agree with those two areas. I suppose the one I'd add for something new is around our development planning and the efficiency of that process. We've just achieved practical completion on Brookfield Place in Sydney, and it's been a 9-year process, and it is a very complex site, but I believe that the property industry generally could be just so much more productive and efficient than it currently is, and I think we could really start with a drill down on planning.
And finally, Adrian, you've dealt with policy for many years. You'll have a word to say.
Oh, look, I think the big one for me, I agree with what Ian, Stuart and Leonie said, but the other one I would do is what's our plan for population and immigration post a COVID recovery, because I think that's driven our economy for a long time, having international migration into this country, and what are we going to do and where are they going to go when they come here, when we do open our borders.
Excellent. Right, thank you for that. Look, we're going to have a quick Q&A. Unfortunately, we're not going to be able to get through all the questions, but I'm just going to read out a few of these and then we'll wind up. We like to keep on time. The first question was just on, and this is a simple one, where there are stats for different performance on the retail segment, et cetera, et cetera. I'm sure there are. Where would anyone suggest as a particular source to actually track that down? Adrian, your stuff that you had from Cushman and Wakefield?
Yeah, no, they can just send me an email at adrian.harrington@charterhall.com.au and I'll shoot you some data.
Okay, next one. Has the rental market got disconnected with the asset market? particularly when there has been a softness in rent through rent reliefs, etc., cap rates still firming, etc.
I can take that, Peter.
Please.
We definitely saw it last year, Q2. We have our properties all valued independently every quarter. So in Q2, there was, I believe, a real disconnect. The independent valuation community really dialed down the rental growth prospects for the office market in Australia. So there were no changes to investment metrics, cap rates and discount rates didn't change, but they were dialed right down on the supposition that the current environment would be in place for 10 years. So I think at that time there was a disconnect. We're already seeing that starting to retrace now.
Okay. Next one, Chinese capital investments are down in Australia. Do you see other market players picking up the slack? And also, do you see the current political conflicts with China increasing market risks? Ian.
I think what is down is Chinese developers putting capital into Australia, and that's been dictated to them by their government. But institutional capital from CIC, the Chinese Sovereign Wealth Fund, is not down. They've recently purchased 50% of Grosvenor Place, the other 50%, and are very keen to buy more. But it's the developers that have been pulled back.
Okay. Does anyone want to talk about debt? Ian, I know you've got a bit of an interest in that and the fact we weren't able to cover that today, just very quickly. What specifically about debt? Just the interest of foreign institutions actually coming in with debt for Australian real estate. Okay. Lim Lei Wah would have told us that offshore banks are very keen to commit debt capital to Australian real estate for all the reasons that Stuart and Adrian outlined. Obviously, they need to raise Australian capital themselves, so they're using a mix of offshore and onshore capital that they raise to lend into Australian commercial real estate, and they're very keen to build their book with Australian institutional investors, but their main entree into the market is through offshore institutional investors that they have relationships with. And so the Yishang Redwood GIC acquisition of the portfolio that Stuart sold, I think I'm right in saying is going to be fully, the debt funding side will be fully offshore with a series of banks led by UOB. I'm sorry for the other people who asked questions, we just haven't quite got the time. We'll have to move on to announcement of upcoming events, please, Alex, just what there is, if you can put that slide up. These are just some events coming up for ULI. There's one in particular, which is the third part of this series, and that's between Melbourne Uni again and ULI, and that's focusing on emerging investment markets and how technological advancement is opening up alternative opportunities for traditional property investors. That'll be moderated by David McCracken, the Executive Director of ULI, and he'll moderate a discussion by Majid Savi and Jonathan Hannam. Majid is Professor of Transport for Smart Cities at Melbourne University, and Jonathan is Joint MD for Taronga Ventures. This webinar will consider the future market, how it's being transformed through prop tech initiatives, how traditional investments are being disrupted and realigned to a new paradigm, informed by community conscience, ESG, technology, big data and transportation. It'll have a strong futuristic bent, and we hope this may be of interest to everyone who's dialed into today's session, so we look forward to seeing you again at that webinar. Thank you everyone for your participating today, panelists in particular, Melbourne University, ULI for making this possible. We hope you've enjoyed it, and we look forward to seeing you again in approximately 1 month's time. So take care. Thank you.
Thank you.
Thanks a lot,
Bye.
Peter.
Bye.
Bye-bye. Bye.